Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist. Taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
Hi, everybody. Welcome back to episode 131 of Carson's Facts versus Feelings. Ryan and Sonu here. We're titling this one, Is the Recession Imminent? And I was glad because imminent's like a hard word to spell. I don't want to spell it, but I can say it, Sonu. But we're going to do something a little different.
Don't make me spell it.
No, I know. Instead of banter, we're just going to dive right in. So, and then we'll do some banter later. Sonu, the U.S. dollar has been crashing. Did we just lose reserve currency status? See how I started? He didn't know this was coming right off the bat.
Wow.
Right off the bat, man. I'm coming with the big
dude,
guns.
I come back from travel and you
I know,
throw
hit
that
you
at
with that.
me.
I know, not a good friend, am I? Not a good friend.
Yeah.
But I will say, so for this question, I'm gonna wear my Easter bunny glasses because it's Easter. There you go on the YouTube channel. I have my bunny glasses. So just for this answer, I will wear the bunny on the YouTube channel. Then I'll take this off. Yeah.
I've said no, not yet. At least
Okay.
I'm going to qualify it by saying not yet.
Mm-hmm.
Right? But are we in danger of it? I don't think so. But let's say last week was a shock.
Yeah.
We had a crisis. All right. And let's be clear, it was a crisis. Things were crashing. Right? Yes, it came back. The S&P 500 gained 9.5% on Wednesday.
Mm-hmm. Yeah.
But during the crisis, and we're still down relative to, where things were, for the market, for the equity market, relative to where things were on Liberation Day, April 2nd.
Yep.
You're still down from there. Right, the market's down about 3-4%, something. The S&P 500 is down
8 on the year, but yes,
yeah,
like that.
about 4% down.
Yep.
Normally, what would you say? You say, okay, bond should be a diversifier.
Oh,
yes, I know there's inflation's a problem. So you're like, okay, maybe there's a chance this could be different because tariffs are going to raise prices, and maybe bonds don't do as well. And yes, interest rates went up 25, 26 basis points. The 10-year yield.
Mm-hmm.
Right. You say, okay, fine. Maybe this is a replica of what happened in 2022. If U.S. interest rates go up, what does that mean? That means if you put money into the U.S., you get more, right? Instead of getting 425 or 420, something like that. Now you're getting something closer to 440, 450, 4.5%. That's what I mean, right? That would mean the U.S. is more attractive. There should be more flows into the U.S. and the U.S. dollar goes up. Just from the fact that interest rates went up, it's more attractive. Not to mention the fact that historically, at least in history as far as you and I are concerned, during our professional careers, anytime you have a crisis, what happens? The dollar goes up.
Yep.
We saw the opposite. The dollar went down about 4%.
Yeah. Big
during
move.
this crisis. Big move. The dollar since January, the dollar is down 9%. Right? I remember when you came into this year, I think you were sharing numbers that the dollar looks too stretched.
Mm-hmm. Yeah.
Right, fine. And we thought, okay, maybe, the dollar continuing to go up was a risk, right? Because that's a risk for multinational profits, all of that.
Sure.
And so I said, maybe the dollar doesn't go up. Maybe it comes down. Maybe it comes down a little bit. It's flat, whatever, right? But 9% lower relative to mid-January is a big move. 4% lower during a massive crisis is a big move. And the question is, and we can share the chart, right? During a crisis, what happened? Stocks fell, bond yields rose, the dollar fell.
Mm-hmm.
I haven't seen this before. Does that mean we've lost reserve currency status? I don't think so, but we've lost something here.
Well, no, well, I'm thinking things we've lost. We've lost a little bit there. Listen, in 22, terrible bear market, 25% bear market. Yields were higher. It was a horrible year for a diversified portfolio because stocks and bonds both did poorly. The first 10 months of 22, the dollar had like one of its best 10-month rallies we've seen in a long time. March of 2020, COVID, stocks sold off, bonds sold off, gold sold off. Initially, after everything started, go look that up. The dollar was the cleanest shirt of dirty laundry and soared higher. So now here we are in another crisis, and the dollar is not acting the way we would have assumed. So that is a big question. But Sonu, I love this quote by James Carville. A lot of people have shared it. In 1993, he said this: "I used to think that if there was reincarnation." Oh, just had a thing pop up here.
Oh, sorry, that was me. I was just telling Josh, the producer for everyone listening.
Yeah.
I was showing the chart showing the falling stock market, rising bond yields, falling dollar during this time. So you'll see it on the screen if you're looking at YouTube.
Perfect, on the YouTube channel. It's great. Yeah. So Carville said this. He was well, what was he? Like a strategist for Clinton. He did something for Clinton,
yeah.
He did something
advisor,
advisor,
strategist, guru, whatever.
Yeah. Raging Cajun. Anyway, I used to think that if there was reincarnation, I wanted to come back as the president or a pope or a 400 baseball hitter. But now I'd like to come back as the bond market because you can intimidate everyone. So let's rewind for a second. On Tuesday night last week, we're all going to bed. We know those tariffs are going to come in at midnight, right? Eastern time, at least. And the 10-year was soaring up over 5%. There was panic in the air. Futures were crashing. There was a lot of worry, Sonu. And then less than 13 hours later, President Trump said, not so sure. we're gonna say 90 days and 10% across the board. China, you get a little more because we're not getting along with you. But everybody else, you get 90 days. And then you see the Wall Street Journal wrote an amazing article. I guess they had inside sources. Said, the gist of it was President Trump could have taken maybe a minor recession. He could have accepted maybe a bear market, but he did not want to mess around with the bond market, right? $50 trillion bond market. It was saying, we don't like what you're doing. And when the bond market crashes along with everything else, that's a really, really bad scenario. So did President Trump blink, I guess? I mean, only one more thing. I didn't know this, but apparently the first time he started talking, President Trump, well, he's Donald Trump back then, started really talking about tariffs, okay? He wanted to buy the piano that was in the movie Casablanca. Famous piano, wanted to buy it.
Okay.
He was like, I don't know if it's held. There was no online back then, so it wasn't online. Maybe it was in person, whatever it was. He was about to buy it, and at the last second, a billionaire from Japan.
From Japan came,
it's the late 80s. A lot of money in Japan in the late 80s. Someone swooped in and bought that piano. 2 days later, he goes on Diane Sawyer's nighttime show, whatever, and just starts ripping everybody, ripping policy. Because he was mad he didn't get the piano that he wanted. And he's been talking about tariffs ever since, and he had his great chance to do it, and it took 13 hours, and he changed his mind. I don't know.
Can somebody send that piano to the White House right now, please?
Where is that piano? That's something to ask.
If that solves the problem,
he must be just airdrop a piano in the next time he's doing something in the Rose Garden. By the way, my Ohio State Buckeyes were at the
I saw
there yesterday, and JD Vance, an Ohio boy, were at the road from me. He dropped it. I don't know if he broke it, but he dropped it. But yeah, that wasn't good, JD. He's actually like my neighbor. He doesn't live that far away. I'll never see him because you can't get close to JD's house.
Yeah.
But anyway, he lives in Cincinnati, although he's always going somewhere. I don't know where I was going with this. Did President Trump blink? That's where we're going. Yeah.
I'll put it this way: the bond market made him blink.
Mm-hmm. Yeah.
That's it. Like connecting literally what we were just talking about. Well, I think it all seems so far away. I mean, so much has happened over the last 2 weeks. But no, like maybe it was last Sunday or something. Scott Besson was on TV and he was like, "Oh no, the market pulling back is just because of the Mag 7, and we're not worried about that." Right? And like, I honestly think they were like ready. They would have been willing to, I think, take some pain, maybe a lot of pain in the stock market. 20% down, maybe even 25, maybe even 30. I think 40 would be a problem.
It was pretty painful. Painful.
30%, I think they would have taken it. They said, you know what? No, stocks come back. I mean, you and I know the numbers, right? Stocks come back. I don't think they were ready to take pain in the bond market. Nobody is ready to take pain in the bond market, especially because when Besson came in, remember what he said? He was like, we want lower interest rates. You want the lower 10-year yield. And guess, I mean, you and I have been talking about it. I've been saying for several months now, the Fed should cut because inflation is no longer a problem. And we need to boost the housing market. Housing's struggling with, 6.5%, 7% mortgage rates. So you had to get that 10-year yield to come down. Now, the easy way to do it is, well, not the easy way, is just put the economy into a recession. Right? And then you get that. We'll talk about that, recession odds, things like that. But, and that's why I think the administration was like, maybe if you have a little bit of a slowdown, we engineer a slowdown, maybe 10-year bond yields will come down. Well, they engineered a slowdown, but the bond yield went the other way. And now they're like, we need to blink. And they did.
And they did. I know one other thing I sent Josh was President Trump's tweet. And on, I guess it was Wednesday the 9th. It was Wednesday the 9th. President Trump, let me make sure I read it correctly. I've got it here somewhere.
I love it.
Okay, all caps, because why would you not have all caps? This is a great time to buy. With, I don't know, what is that? It's like 3 or 4 exclamation points. And then he signed it DJT.
And that was in the morning,
that
right?
was in the
Wednesday
morning. And a couple hours later, we had a 9.5% rally by the end of the day, the third largest rally in the history, or well, at least back to World War II on the S&P 500. Truly amazing. What else? Josh, you can go ahead and put up the advanced decline one about the volume. So how rare was Wednesday? Yeah, it was a huge update, but 98.6% of all the volume on the NYSE was up that day. Okay, we've got data back to 1980 from our friends over at Ned Davis, and I love Ned Davis research.
I'm curious what didn't go up that day.
Well, that's a good point. We should look that up. But apparently, there was about 1% of the volume went down. I don't know. That's not a good day there, but that's the most we've ever seen. Wow. And historically, when you see some previous dates that were ballpark that strong, was the lows in August of 82, the lows in March of 2003, a couple times in 2011 and 12, some major lows. So, yeah, I mean, everyone's saying this is a bear market rally, and that's how all these start, And I tell you, our friend Scott Brown over at, what's it called? Brown? Oh, I should know.
Brown Technical Research?
Brown
Research?
But Scott Brown, research. Just look up Scott. Sorry, Scott, we're not knowing. But Scott pointed out, we were about as oversold as you can get. Less than 2% of all the stocks above their 20-day moving average, about 5% 50-day, less than 20% 200-day. That is in washout territory. And then you get this huge bounce. But what you tend to have is what we call a bang and whimper. So the bang was that big drop that we saw into last Monday when the VIX spiked to 60, everything going crazy. Then we bounced, and we bounced pretty nicely, honestly. And then you kind of whimper back down. Maybe retest it, maybe not, but you whimper back down. But you see better internals, less stocks making new lows, some positive things under the surface. So we had the bang. We're in the local area, maybe a potential low, but then we go back and maybe potentially retest it with some better news out there. One other thing from Scott, and then Sonu, I'll let you go. Yeah. He pointed this out on Monday. We came in last Monday, so this 2 Mondays ago. Obviously, just I mean, futures were down. Everything was looking bad. So opened.
This was Monday the 7th.
Monday the 7th. Yes, That's exactly right. We opened down on the S&P more than 2%. So we opened way red. And then you close your eyes until the close on Friday, and we were up on the week more than 5%. So that's a pretty significant washout, whatever we call it. Scott noted, I think it was May of 1970, the only other, the most recent time we've seen something like that on a weekly basis from Monday to Friday, that big of a selling in the beginning and then strength at the end of the day. And the S&P was up like 46% multi-year a couple years later in a really strong bull market. Who knows? I get it. But, we've got some extreme negativity. Sonu, what else you want to talk about with kind of the market action? And then maybe we'll finish with the economy.
Yeah, so let's go back to bonds and why, because there was a lot of things about, bond yields are rising and why it was going up, right? Because, I think stocks are just straight out, especially if you look at small caps, for example, right? From Liberation Day, the Russell 2000 is down about 8%. So small caps, I think if you look at especially a differential between small caps, large caps, I think there's, the market's pricing a high probability of recession, right? Whatever that probability is, which is not to say there will be one or won't be one. Market pricing can always change, but bonds are the question of why were bond yields going up, right? And I think a lot of people are like, maybe China's retaliating, right? Maybe China's selling treasuries, right? And let's say the U.S. just to clarify the numbers here, right? The U.S. Treasury market is about marketable securities, anywhere 20 to 30 trillion. I mean, Social Security has a lot of treasuries, things like that, so it could be totally about the $35 trillion. China owns about $750 billion worth of treasuries. So in the big scheme of things, they don't own a lot. In fact, they haven't been buying a lot of treasuries for about a decade now.
Well, we've had a trade war with them since at least 2018. Yeah. So,
and they've started to diversify outside. And gold has been going up. The Chinese central bank has been buying gold as well. That's one of the reasons. One of the many reasons I think gold has gotten a bid over the last 2 years, not just last 3 months or anything like that, right? Gold has done well through this crisis as well. So the question is is China selling, right? Are they selling treasuries? But you think about it, if they sell treasuries, what needs to happen? They're selling US dollars. They have to buy something with it. What do they have to buy their own currency, in which case their currency actually has to go up. It has to appreciate.
They don't like that.
Yeah, they don't like that.
They don't like that. They don't like a higher currency.
Yeah, no, exactly. Right. They don't like a higher currency. In fact, over the last week, over the last month, we've seen the Chinese currency depreciate slowly. That's because the central bank controls it, right? They have capital controls, things like that. They engineered a decline. So we literally saw the opposite of what you would expect if China was selling and dumping U.S. treasuries, right? So I think there was a lot going on. Like, is it China? And then there was like, is it something called the basis trade? Hedge funds that are very levered, betting on interest rates going down, but instead it went up. There was a whole thing about regulations as well. Scott Besson, when he came in, he said he's going to ease regulations for the banks, which means they can buy more treasuries, which means yields, there's more demand for treasuries. And so prices will go up, yields will go down because it's opposite for bonds, right? Mm-hmm. I think I got that right. Yeah. But that hasn't happened, obviously. So things have gone the other way. And these trades are enormously leveraged, like 50 times, 100 times levered, right? Because usually you pick up literally pennies on the dollar. You can't really make a big profit unless you're really levered up. So there are a lot of things going on with respect to, like, why did, bond yields go up last Tuesday night, right? I think it's still unclear. But I think I'm pretty confident in saying, look, the data is going to come out only 2 months from now. Like China's holding a treasury bonds. I don't think it was them. In fact, I don't think it was anyone else, right? It was just market structure, what was happening, as funds delevered, things like that. I think that's more of the story rather than anything else.
Very interesting. Let's not forget the flash crash. And I guess there was some flash crash back in the 60s, but the one I know, because I went through it, was May 10th, 2010, I believe was the date. I'm pretty sure that was the date. Definitely May of 2010. We still can't agree on what caused the flash crash. We still can't agree on what caused 87 crash. So listen, these things happen. There's not always a clean answer is the honest answer. But that's something to remember. You mentioned banks, just high level. And so far, banks have had pretty good earnings. Banks kind of kick off. Delta technically anymore. Remember Alcoa used to kick off earnings season. Apparently it's like Delta now. Delta came out on Wednesday and said, never mind, we don't have a guidance anymore. And the stock went up 23%. A lot of that was because obviously what happened with tariffs. But it'll be interesting to see this earnings season. We'll talk a lot more about it. But so far, earnings season's early, and these banks have actually done pretty well relative to expectations. Now, Josh, one chart I know I sent you was kind of all the bear markets. And the idea, so we'll share this on YouTube. We've had, Sonu, some what we call near bear markets since 1990. 19% peak to trough corrections in 1990, 1998, 2011, and 2018. And I know 2011 and 2018 hit intraday down 20%ers, didn't on a closing basis, but close enough for government work. This one hit 20%, I think a couple times. Intraday, never officially did. Now we bounced well over 10% from the lows. We'll see by the time you listen to this where we are. But I just think it's interesting that we've had these near bears. And when you have a recession, this isn't probably rocket science, but your bear market goes down like 34%. When in a non-recessionary bear market, which absolutely can happen, down about 24%. Does that sound familiar? 2022 was down about 25%. We shared this data back then saying, listen, we still don't see a recession. People hated that call, but looking back, it was accurate. And we had I'm going to say normal run-of-the-mill bear, but if you were in the market for those 10 months, that was really, really painful. So what didn't feel normal, but actually it happens, right? So that's where we were. So again, if we can avoid a recession, which is kind of a segue to where we're going to go, maybe we were ballpark where we were, but the market's all about expectations. The last thing I'll point out, Josh, you can point up the chart about the expectations on recessions, right? The Bank of America Global Fund Manager Survey came out this morning, Sonu. So maybe you had a chance to look, maybe you haven't. I'm going to point out some highlights and love your takeaway here. Not surprisingly, I mean, global. These are the people that manage real money, hundreds of billions of dollars. There's a lot of fear out there. Cash had its largest 2-month spike since April of 2020. Global investors expect to cut U.S. allocations the most ever. All right. And then recession expectations, which I believe we're sharing on the screen here, had what did I read it here? Is the highest it's ever the fourth highest it's ever been. That's what that word is on my piece of paper. Fourth highest it's ever been. Only March of 2009, April of 2020, and November of 23 were higher. Now, all of those times were not the worst time. You know what? Sorry, November 22. Apologies. November 22. But those 3 times were after rough markets, were after rough economies. Yes. But once everyone got all recessioned up, the market did actually do pretty well from those points of view. So I don't know. And trust me, you could say, well, 5 weeks ago we said sentiment was negative, and I would have agreed. And now here we are. So I get those parts of it. But what's your take on some of those concepts we just talked about there, Sonny?
Let's go back to Josh. If you want to put up Ryan's chart, which I love, like the one where he says there have been many near bears lately.
Okay, the near bear chart. Yep.
Yeah, near bear charts. I like how if you're looking at this on YouTube, Ryan's highlighted in bold the near bears, right? You got 1990, 1998, 2011, 2018. right? And 2025, like
And now
we don't know what. Yeah, maybe.
maybe.
Right?
Hopefully.
Let's
I don't know.
take, let's take those 4 times, right? 1990, and this is what you think about as markets start to go down. You need some catalyst. You and I always talk about this. You need some catalyst to stop it, right? And it's interesting. It usually stops around 20%, but maybe that's when real panic sets in.
Yeah.
Right.
Yeah,
and
true.
for whatever reason, maybe, like, oh my God, because once you get to 20, the question is, are we going to 30 then?
Well,
Right?
everybody and their mother knew we were in a bear market a week ago, right? 'Cause it was all over the news. So
Right.
that brings the panic out.
But then usually what happens, 1990, 98, 2011, 2018, policies makers step in. The Fed steps in.
There we go.
Fed, remember, they were cutting rates in 1990. Greenspan cutting rates in 1998. 2011, rates are already 0, but then they started doing QE again.
Yep.
Right. Then, a year later, we got QE. We got QE twist.
Yeah.
Right. They started buying long-term bonds. Like, there's a bunch of stuff happening there.
A bunch of those
right. And 2018, yes, we bottomed on December 24th. The Fed was raising rates amid the trade war, and then the market is basically sending the message to policymakers: stop. January 3rd of 2019, Powell came out and changed tune. Done.
Yep.
Right? So that was, I think, this time, the Fed is on the sidelines. And we needed some catalyst, and that's the catalyst we got on Wednesday. It was a policy catalyst. Trump blinked.
Exactly.
It was a policy catalyst. That's what took things out. Look, tomorrow if he comes and says, I'm done, there is some damage. I'm not saying there's damage here, right? Like, and there's maybe instead of, and one way to think about, okay, how does this damage get quantified in the markets? I think one way to think about it is, do U.S. equities deserve the same valuation premium they did at the beginning of the year, right? Beginning of the year valuations based on forward PEs, forward price earnings multiples, were about 21, 22, something like that, right? Do they still deserve it because of the extra risk now, right? Like, yes, maybe President Trump says, you know what, I'm taking everything out, even the 10% baseline tariffs. That would spark.
You got me smile all of a sudden.
Right. But there is still the risk that 6 months from now he can change his tune.
Okay.
So we may not quite get back, like in the beginning of the year we were saying 10 to 15%. And I'm not saying, who knows, we could end up in the same place, right? Like, but I don't think like the risk premium, goes down from here. I think there's still some risk, and that's the effect of everything that's happened, right? So I think policymakers have to step in. In this case, it wasn't the Fed. Trump just blinked and he said, oh, you know what? 90-day pause. Right. And then it's same thing over the weekend, by the way. We haven't even touched on the weekend, right? Like,
I don't know. It'll change by the time people
China tariffs, 145%.
Yeah.
Our friend Dan Ives was losing his, whatever.
By the way, we'll be live with Dan Ives in Omaha in May at our partner summit. Now, honestly, if you want to join, become a Carson partner. You can not come to this one. We'll probably share some of it, and it'll probably be a Facts versus Feelings after the fact. But yeah, the third week of May, we've got Dan Ives live, and I am so excited about what I'm going to wear. You and I need to, because you know what Dan's going to wear, something crazy. We're gonna go all out. We're gonna look like Dan Ives.
There you go.
But yeah. So what did Dan say over the weekend?
Yeah, Dan was like, "This is crazy. Like, Apple cannot function." With these tariffs on. No way. And guess what happened? Like, I'm not saying this is because of Dan. Who knows? I'm sure he's got a, hotline into the White House probably.
Yeah, he does.
But so does, Tim Cook probably, right? And
yeah. Trump answers his phone call on the golf course. I think he answers Tim Cook when he calls on the golf course. Yeah.
Yes. So I'm sure the calls are coming in. The calls are coming from everyone and everybody, right? Saying, you cannot do this. I mean, think of all those people sitting next to Trump during his inauguration.
They all were there. Mag 7 was there.
Mag 7 was there in full force.
Yes,
right?
They were. Front row.
Yeah. And what? They depend, you can't have 445% tariffs on China. And again, he blinked again on Sunday, right? What was interesting is the U.S. is now, everyone keeps asking, like, who holds the cards, right? Like, don't we have more? And the general thing is, we import from them, so they're dependent on us. And there is an aspect to that, right? So maybe we hold all the cards. And I think the Trump administration kind of tested that. But the problem is trade is the other side of profits.
Okay.
Trade is the other side of profits. I mean, if you're making profits on your iPhones, if you're making profits on all this stuff that is made in China, suddenly you have a trade war that's looking to break all these linkages. that means all the linkages through how you make profits is also torn up, right? And I think that's what essentially that was a fear on Sunday night, and and that's why the administration was like, oh, we're going to pause that. We're not going to put the tariffs on consumer electronics. The irony is that they still have tariffs on intermediate and capital goods. So in a sense, you're kind of screwing over U.S. manufacturing,
right,
and still getting all the stuff from China without tariffs. So I don't know where all this ends up, but
okay.
Yeah, it is not like we haven't sorted any of this out. Which comes to the question then: recession.
Well, let me jump in before we go there. I mean, I think that's why we just had pretty much a virtual bear market, because there is so much uncertainty and confusion. Now, you mentioned risk. One risk you have is when you have a 105-pound crazy Great Dane like I do. I was on the floor the other day. She jumped up and she scratched my face. All right.
Oh.
And then I go upstairs. This is Sunday. This is on Sunday. I go upstairs.
Was she mad at you, or was she excited?
She's playing. She loves everybody. She's playing. Anyway, so I go upstairs to see my son Gus. He looks at me and goes, "Why are you bleeding all over the place?" I go, "Look, my whole." So I know in the YouTube channel, I don't know if you can tell, I got a scratch. My dog scratched me right on my chin. Or no, sorry, my cheek. And those are some risks. Now, I will also say this.
There we go.
Facts versus feelings at carsongroup.com is versus VS is our email. One of our great listeners, Jake, sent this song, and I'm going to play just like a minute of it. Maybe at the end we'll play the whole song, and this is, we have approval because Jake made this song. So he made a song about me and the stock market. And this is kind of our little intermission, maybe before we talk about the economy. I'll just play a little bit of it. You want to listen to the whole thing, we'll probably play it at the end of the podcast. But it's called Ryan, the Savior of Stocks. Thanks to our friend Jake Gutman here. Here we go. It's got a good beat, trust me. Watch Sonu's head's gonna start bobbing. I can tell.
I'm tapping my feet.
Bulls turn to bears in just a short while. Ryan steps in with that confident grin. Wall Street's chaos, let the game begin. Oh, Ryan's got the golden touch, making numbers climb so much, saving stocks from certain doom, turning panic into boom.
All right.
All right.
So that's the first 48 seconds. It's 4 minutes long. And this is the beauty of AI. You can just say, make a song about Ryan Detrick in the stock market. And apparently a few seconds later, it spits that out. So it's got a real catchy beat. The words are pretty funny. So again, I'll get this to Josh and we'll play the whole song.
Next time you're on CNBC, you should just play that. And
Ryan the Savior. I thought we should title this Ryan the Savior of Stocks, honestly, but I thought that was a little too extreme. All right, that was got a little intermission. I'm looking at the clock. Let's say maybe 10 minutes or so. Let's go another 10 minutes or so. Let's answer the question of this week's Facts versus Feelings, episode 31. Is a recession imminent? Sonu, we're hearing it is. I know your odds are higher than it was a month ago because of everything going on. Yes. Let's talk about the economy and recessions. Take it away. Okay.
I'm looking at a poll, CNBC. This was yesterday or something. The survey polls 300 CEOs in April. 62% say that they forecasted a recession or other economic downturn in the next 6 months. Right? Okay. And it was 48% in March. So most CEOs, who you would think have an idea what's happening, but I have a take on that too. They think there's a recession in the next 6 months. So my one thing with CEOs, I'll say that like they're great. Like Jamie Dimon, for example. Let's pick and there's no question that he's a great CEO. Period. Right? Great CEO. He's talked in the past about economic hurricanes and market hurricanes and things like that. So I think, no offense to CEOs, but I think they have blinders as to what's happening for their company, for their industry and sector, right? They're not really looking at the aggregate picture, and you have to look at the aggregate picture, right? And then when you think about a recession, most people are thinking about, 2 quarters, let's say two quarters negative GDP growth sometimes. I mean, that's not even a technical definition, right? It's just sort of like, okay, that's an easy heuristic. I'll put it as not even a technical definition. In the US, it's the National Bureau of Economic Research, NBER, that defines a recession. The thing is, you can't wait for them to declare a recession. because by then stocks are probably up 10, 20%. Our stocks are already rallied, right? By the time NBER declares a recession, because yes, they're looking at a variety of indicators. They're looking at consumption, income, production, and employment, right? There's about 6 indicators that they look at across these things. And they're trying to figure out, okay, are these in contraction? And then 6 months later, a year later, they can say, oh, the recession started and so month, right? And then it's only after, maybe a year, 2 years after the recession ends that they finally come out and say, because remember, all of this data gets revised as well, right? Even if you look at payroll data, right? You cannot use payroll data in our business, the business you and I are in. NBER is in a different business. They can wait 2 years, say, oh, the recession's ended. You and I are in the business of, figuring out how does economic risk translate to market risk, right? And for that, you cannot forget NBER. You can't even wait for GDP data. You have to think about what's happening in the economy today. We're in April right now, April 15th. We're done with, we're 15 days removed from the last quarter. You still haven't gotten GDP data. And that GDP data for Q1 is going to be revised.
Happy Tax Day, everybody, by the way. April 15th, the day we're doing this. 15th, anyway, April 15th. But you won't hear this until tomorrow, but nonetheless, Happy Tax Day.
No, exactly. So you have to look at, okay, how is, so when I think about a recession, I'm not thinking about, GDP growth coming down and bottoming and going up. By then, it's too late. We can't be in that business. So the question is, okay, are there risks to the economy where suddenly incomes are falling, layoffs are rising, things like that, right? We don't have to wait till GDP data comes out to tell us that.
Okay.
Right? In fact, I would say NBER is really lagging. GDP is very lagging. Even earnings, right? We're just about starting to get earnings for Q1, but that's late. That's delayed. You don't want to wait for earnings to bottom. Say, oh yeah, okay, earnings are bottom. Now we're going to buy, right? Or earnings are starting to go down. Now we're going to sell. No, you try to act well before this stuff. And I think we have enough data for that. So then the question is, okay, from that perspective, are we running into a place where all this economic data, whether it's retail sales, income, and especially labor market data, is that going the wrong way? Right? Where it creates a big risk for markets. It creates a big risk for profits. Right now, we're not there. And that's partly because, we haven't gotten the data for March and April. But I don't think the unemployment rate is going to jump up to, let's say it's at 4.1%, 4.115% right now. I don't think it's going to jump up to 4.5% in June.
Okay.
May and June. Maybe. Okay. I'm not saying it's out of the question. Suddenly layoffs spike. We haven't seen that yet, by the way, in initial claims. If layoffs starts to spike, we should see it in initial claims.
And continuing claims last week fell. I know you were out of the country, but continuing claims actually fell more than expected, and claims haven't spiked. So there's some positives out there.
So my thing is, I'm not so sure. I'm not saying this is 0% chance of a recession, right? I am skeptical that we'll get into a recession over the next 2-3 months. Or even 4 months, let's say into July and August, right? We're in April right now. Because partly, I think consumers are going to try to front-run tariffs, especially now that we have a 90-day pause, right?
Well, you just bought 3 cars, right? Didn't you?
No, I am honest. No, I'm considering it.
I know.
Considering it. Yeah. Right? I just saw the news that Canada's also given a break for auto tariffs from their side, so for some time, right? So all of this stuff is happening. We are on 90-day pause, which actually I don't think that's a good thing. Yes, it's good temporarily, but the very fact that it's temporary is not a good thing. Either do it all now or don't do it.
I think I said last week, 90 days is about July 4th. So maybe we just have a big old July 4th party and say all the tariffs are over and away we go.
Yeah. My guess is we get to July 6th or whatever it is, and then we get another 90-day pause. None of this stuff is helping, right?
Boy, yeah.
So I think that's my guess. If I had to pick, what is my base case, I'm saying this thing is just going to get prolonged and prolonged. But that prolongs uncertainty too, right? But what's going to happen is businesses are going to try and build up inventories as well, which means there's going to be in the interim, right? Let's say April, May, you may actually see production pick up a little bit, inventories going up. Yeah, all these weird skewed data. I think that economic data is going to be very iffy, if that's a word, for the next 2 months.
It is on our podcast. We can say whatever we want.
Right, we can say it. Yeah. The one thing I think where the data that I'm really looking at, and it's always like it's labor market data. I don't think that, look, if companies are worried, what do? They say, you know what, we're worried about cash flows. We got to get rid of people.
Yep.
And you'll see layoffs. But we're going to start seeing that. Yes, we always get anecdotes, Challenger, layoffs in the tech industry. We saw that 2 years ago. We didn't get a recession.
Oh, every January we get tech layoffs, and everybody says, here it comes, and not yet.
No, exactly. We should say, but think about it. That's where you're differentiating between what's happening in certain pockets of the economy versus the aggregate economy, right? Okay. And we should see that in things like claims. And we should see that in the unemployment rate, right? If the unemployment rate, let's say, like by July, if the unemployment rate gets to, say, 4.5, 4.6%, I'm going to say we're in big trouble here. Because once this thing starts moving, it'll keep moving.
Yeah.
Right? But that gets back to the Fed as well. Normally, we just got inflation data last week. Right?
Yeah, isn't that crazy? We haven't even talked about that.
Yeah.
Dude, it was good. It was good inflation data.
Really
Imagine a year ago what the market would have done on that news. Yeah.
Or even like 3 weeks ago, right?
That's true.
You and I, we wrote about this on our Outlook. We've been talking about this ad nauseum for like 2 years.
Yeah.
This was normally the blog we would have written as this is the inflation report. The Fed is going to cut. Forget June. They'll probably cut in May.
Yeah.
We'd be talking rate cuts right now in May. And core PCE, personal consumption expenditures index for, what's it? March. For March, yeah. For March. Is on track to run below 10 basis points, below 0.1%.
Yeah. Wow.
We'd be talking like, maybe at least 50, 60% odds of a rate cut in May, maybe 100% chance of a rate cut by June. And now the market's pricing in a rate cut by June, but that's because the market thinks there's going to be a recession.
Right.
Unemployment rate is going to go up.
The bad types of cuts. Types of cuts.
Exactly.
Good cuts are if inflation's not a problem, like the mid 90s, and honestly, kind of like we saw last year. But now it's a new year.
But now that's what I'm honestly in the camp that unless we see the unemployment rate spike, like I said, to 4.55, 4.6%, which I'm a little skeptical it will immediately. I'm not seeing that yet, right? I don't think the Fed cuts.
Okay.
But I think that raises the risk. I'm more worried about a recession. Like, I'm not going to put a probability. Like, that's subjective. Like, who cares about someone's probability? I think the odds are high that we run into trouble by the end of the year or beginning of next year. That's because, look, if it is just tariffs, companies can deal with it, right? If Trump comes and said today, you know what, we're sticking with 125% tariffs on China, whatever. 20% tariffs on the EU, 46% tariffs on on Vietnam. Forget any deals. I'm not wasting my time. I want to play golf. Scott Besson, you go play golf. Howard Lutnick, whatever it is you do, you do.
He might be gone by then. I don't know.
I know. Like, if you had to take a bet on who leaves first, right?
Yeah.
But like companies can figure that out. Given tariff rate, yes, there may be a little pain, but okay, you adjust earnings for 2025, 2026. Maybe everything comes back, or maybe by 2027.
Well,
you figure that out, right? But now we are in a situation where we don't know what's happening. So then the question is, okay, are companies going to, well, we know the answer to that. They're not going to really make investments. They're going to sit back, build up inventories for now, just so that they have non-tariffed goods to push to consumers.
Okay.
Right? But are you going to build a new factory right now? Right? If you're Nike, should you move your factories from Vietnam to the US? Who are you going to hire? Like, do Americans want to make sneakers? Or if you're a pharma company, do you move your pharmaceutical production from Ireland back to the United States? Because now you have a 20% tariff. You may not have a 20%. It may make sense to move it if there is a 20% tariff, but if there is not,
you're right. 6 months, it's not there. July 4th, it's not there.
Exactly. Okay. So basically, what I'm getting at for GDP growth, if you think about what's in GDP, forget the volatile stuff. Net exports minus imports. Forget inventories. Right? You're talking about final demand. Government. By the way, that's mostly state and local. It's not federal, right? State and local government is 12% of the economy. That's slowing down because now they don't have the cushion of all the money they got from the COVID stuff. Right? The COVID stimulus from the federal government. So that's slowly falling away. Investment is another big part of it. investment, I think, is has just stopped. I mean, who's going to invest right now? Who's going to put up a new building or a new factory? Remember the chart you and I kept talking about over the last 2 years? Manufacturing, construction, right?
Soaring. Yeah.
That's done because, who's going to do that anymore? And then we were talking about this would be the time we'd be looking for companies to buy equipment to populate those factories. But now you put 100% tariffs on the equipment that you need. So are they going to invest in that, or what are they going to do? So you're not going to see that, which leaves the consumer, right? And for the consumer, I think it gets back to the key is the labor market.
Okay. Yeah.
And I think for right now, hiring has eased a lot, right?
Sure.
If you just looked at hiring and say, we may be in a little trouble here. And I think like our good friend Neil Dodd has been talking about this for a long time at Renmac Research, right? The thing is, what's sort of keeping net employment high or relatively okay is the fact that layoffs are low. So I think it just comes back to keep an eye on claims. Like if you ask me, what are you looking at? Claims.
Yeah, you said claims is your favorite one.
If layoffs start to go up, I think we're in big trouble. I don't see that yet. I don't see any signs of that. Like you think all these the 62% of CEOs, forget 62% of CEOs who said, they forecast a recession in the next 6 months or so.
What do Bert says? We need a Bert on here. Bert White, our CEO.
I don't know. I almost don't want to know the answer.
No, I don't want to know either.
But if these CEOs are saying, we're going to get a recession in 6 months, you think, okay, we need to raise cash flow. We need to let people go. Mm-hmm. But like I said, you're going to see that in claims, right? And you'd already been saying, 48% of CEOs started saying that in March.
Sure. But
that hasn't translated to layoffs, not yet. So that my worry, is the Fed keeps rates high for longer, and that starts to just suck on the economy. It just drains the economy slowly. Like in a sense, I'm not wishing for this by any chance. We're almost better off. Like you just go into a big recession right now, and then you get a V-shaped recovery as Trump says, you know what, I'm done with all this. The Fed cuts, boom, it's over, right? By the time we get to December of this year or something. We're not getting that. I think that's like very unlikely right now. But I'm worried we get to Q4.
Okay.
Q1 of 2026. Rates are still high. Mortgage rates are at 7%. Right? There's no, there's no boost from the housing market. The housing market's dead. There's no boost from investment. The labor market is sort of like teetering on the edge. That's not a good situation, I think.
No. And to add to that, next year is a midterm year. And historically, midterm years can be a little dicey. Some things we've talked about internally get through this year, and next year maybe we have to reevaluate some things. So we'll see.
Exactly. Yeah. I mean, you and I, when we did our outlook, we talked what are the risks, and the threats are tariffs. Now that threat is manifested. Okay, put that aside.
That is real as real can be.
And I'll be honest, this is not what I expected. This is just not what I expected. This was not my worst case. My worst case was really bad. This is way beyond that, right? But I thought, okay. Congress could write a tax bill. Maybe they do that first, and then we get into tariffs, and they do it slowly. And that would be, by now we'd be talking about rate cuts. Yep. We'd be talking about tax cuts. We're talking about tariffs instead.
Sounds a lot better. Good. Sounds a lot better.
So rates are still a risk. And I think it was a risk at the rate staying high was always a risk. I was hopeful because the inflation numbers that would come down, but now we've gotten good inflation numbers. Doesn't matter. Because the Fed's like, tariffs are a risk here. It could push up inflation, even if it's transitory, by the way. Right?
There's that word.
Let's say, let me ask you this. I'll throw it back to you. If we don't get rate cuts this year, by the way, that's still not my base case. I'm still expecting a rate cut or two.
Yeah.
Because I'm hoping this passes and Trump says, you know what, I'm done with this at some point. That's the upside. What's the bull case? The bull case is Trump just completely
waves a white flag.
Yeah, that's the bull case, right? So that, if you tell me sort of what's your probability that everything just goes back to normal. Yes, there's some hurt. I think risk premiums, evaluations won't get back to where it was because there's some risk premium here. Well, I'll ask you, what are the odds that Trump waves the white flag? That's my odds.
I think pretty high. I think it's pretty high. I think he liked seeing the stock market go up 9.5% because of something that he quote unquote did. At least he views it that way.
Yeah.
So we'll see. I mean, I guess, I think about what we're doing, right? And the money we run. I mean, we're really preaching to be diversified. Do we have an overweight to equities? Yes. But we had a 91% overweight to equities in our unconstrained models, back in 23, 24. We did a pretty big cut back on March 3rd. We've done a little more. So, we've done some things. We've talked in this very podcast. We added some more international exposure, specifically Europe, just last week. Okay. I mean, we still think, stocks might do okay before this year's over, so we can avoid some of these really bad things we're talking about. But we don't know. No one has a crystal ball. And that's why we're saying in times of uncertainty to be diversified. Grant Engelbart on our team. Yeah, carsongroup.com/research, talking about some of the concepts we're doing. We've talked before about one of our big calls we made this year as being 50% momentum, 50% low vol, right? Yep. And if you do something like that, you've got some offense and some defense. Instead of simply buying SPY, that's a nice way to do it. We've talked about this. I'm not going to get too in the weeds at the end of our podcast, but these are some of the things that we're doing every day for our Carson partners, every day for our Carson partners clients. We're doing special calls. We're doing all types of cool stuff. So some of the stuff we're talking about here, just teasing a little bit, if you will, sounds appealing. Go to carsongroup.com. If you're looking for a really good advisor and you need a better advisor, we've got literally hundreds of them all over the United States. And if you're a current advisor who's not been supported by your current shop as much as you think you should have been, potentially, we would love to talk. We're growing. Mentioned Bert White before, so reach out to Bert and tell him you want to come on over. Now reach out to anybody. But carsongroup.com, there's a lot of cool stuff that we're doing that we hopefully can help.
And if you want to get our stuff, carsongroup.com/research. I love the title of Grant's blog. When in doubt, diversify it out.
There you go. That's I do something.
I love that.
That's good. That's very.
I'm going to use that. When in doubt, diversify it out. And I wrote a blog today about taxes, combining taxes since it's tax day, April 15th, with tariffs. And this gets to the whole thing about we're going to have negotiations and stuff, right? The thing is, Scott Besson's talked about maybe the first ones to the table will be South Korea and Japan. And I'm thinking, wait, we already have free trade agreements with both countries.
Both of them.
What are we going to negotiate?
What can they do? But maybe if they give us their best baseball players, maybe that's what this is.
There you go. Yes.
And they come over for a good deal. Because so the LA Dodgers keep buying them all. The Dodgers got all the money. They keep buying them all. All right, we've gone pretty long. Sonu, any final words of wisdom? We probably need to shut her down here soon.
No, I think there's a lot of uncertainty right now. I don't think we're out of the woods by any stretch of the imaginative, any stretch, unless this can all end if one person decides this is over. I don't think he will, for the reasons that you mentioned, going back to the piano.
Going back to the piano. It all started with the piano.
It's all because of that darn piano. But we'll see. We'll stay on top of this, right? And like I said, make sure your portfolio is well diversified right now.
Absolutely. We're doing all we can. We really appreciate tons of people listening to this. We've had a lot of downloads. We actually have we can announce who's next week. You want to announce it? Who do we have next week? You want to give a little teaser just for the listeners? I think we should.
Yeah, we got Kathy Wood on.
Kathy Wood joining us.
I mean, I don't know if technologist is the word for it. I think Elon Musk is the technologist, but Kathy Wood is a big booster of technology as well. And I thought I saw some headline. I could be wrong. So I'm conditioning on this that I could be very wrong. I thought she said a recession is very likely. So maybe we could talk about what she's doing in those portfolios as well.
I'm looking forward to her talking. We just listen because she's great. So we've got Kathy next week. So again, thank you to everyone. Let me make sure I read the... Oh, where'd it go? The little disclosure I say, Sonu, about reading, or here we go. Help us out here if you can. If you want to hear the latest from us, don't forget to subscribe to our podcast. You can also leave a review. We love your feedback. So thank you for that. So with all like that, we're going to probably leave to the song that Jake put together.
I was just going to say, we should fade out.
Yeah, we're going to fade out to it. Here. Yeah, okay. I sent him a note. I said, hey, can you give us compliance? And he's in writing. He goes, I never thought you'd have to ask an AI song. Anyway, he gives permission. He gives permission to use it. So I feel very safe to say we can play this
Jake.
song. Yeah, Jake. Ryan, the savior of stocks. We will leave with the song Ryan, a savior to stocks. We'll be back next week on the latest edition of Facts versus Feelings with Kathy Wood, which will be an awesome discussion. Everybody stay strong out there. Let's hope we get a little more green. We'll see you next week. Here comes the song. Take care. Thank you.
The market's crashing, it's a scene so wild. Bulls turn to bears in just a short while. Ryan steps in with that confident grin. Wall Street's chaos, let the game begin. magic on the big